This was in the Wall Street Journal last week. Strippers, Christmas gifts, and an RV. Workers push it with company cards. So, according to the Association of Certified Fraud Examiners, expense fraud is on the rise, and it costs businesses an estimated, get this, 5% of revenue on average.
That's immaterial.
Well, we don't know, David, because auditors don't have to disclose their materiality thresholds. Maybe they should. Maybe that's the takeaway from this is, like, I would be very curious to know what materiality does KPMG use to audit Macy's, and how do they do it? Like, why can't investors know that? It's probably all, it should be all clearly documented in the work papers. Let us know. Maybe SEC can come up with some sort of standard, and it has to get reported in the financial statements. I don't know. Let's figure it out.
So 5% of all fraud, or 5% of revenue is expense reporting fraud.
Yeah, 5% of revenue is lost due to expense fraud. Now, what is expense fraud? Well, here are some examples of expense abuse. Personal expenses on company cards. Employees have charged personal items like family Christmas gifts, romantic getaways, and even attempted large purchases like an RV, all on the company dime. And there's like some really great illustrations in this article. Some employees also misclassify or alter expenses. They might disguise personal expenses as business costs. A great example in the article was a guy who figured out that a strip club was showing up on like the Visa network as like a restaurant. And so he could use his company card there, and it would not get flagged in whatever expense reporting system they're using because it was classified as a restaurant.
Code. Yeah, the merchant code.
Yeah. People manipulate receipts to increase costs so that they get, pocket the difference. And abusing home office allowances was pretty common. During the pandemic, people would funnel home office stipends into unrelated home improvements or personal expenses like daily coffee runs, even seeking mileage reimbursements for working at home. And cited in this article actually is a story that we talked about in the past, which is the Jacksonville Jaguars financial manager, Amit Patel. So he managed to steal $22 million from the NFL team, the Jacksonville Jaguars, by skimming money from expense fraud. He would inflate hotel, airfare, catering, and other expenses, and he did it for 3 years. And I have a follow-up to this, which is that now he's suing FanDuel, the sports betting site, claiming that FanDuel got him addicted to gambling, which is what led to him stealing the money from the Jaguars.
So the owner is suing FanDuel.
Well, the financial manager who stole $22 million is suing FanDuel.
Oh, he's suing FanDuel for
because
being addicted.
His gambling addiction caused him to steal money.
No.
Right. So I think every accountant who has dealt with expense reports has seen this sort of thing, either small or large. And it happens a lot. And that stat from the fraud examiners, the Association of Certified Fraud Examiners, is staggering because 5% of revenue is how much of net income? Just imagine if your company is losing 5% of revenue to expense fraud and you were able to stop it, what would that do to your profit? A lot of companies are making, some businesses like Macy's, it could be a few tiny little fraction of revenue.
Retail and grocery stores,
very margins. Small, right? That's like a huge impact. And, even if you're in a very profitable business, like say an accounting firm where you get, 20% EBITDA in many cases, then like 5% more, like, hey, that's significant. Let's say your net is 10%, your net income's 10%, add 5% to that, right?
I mean, that's employee bonuses for everybody on your team. It starts adding up.
Yeah. So this ties back to the story we're talking about with Macy's is like, how do we stop this? And technology is the answer.